Word on this computer.
Perfect. All right, well, we're going to get started. Just want to thank everyone for showing up. This is quite a great attendance today. My name is AJ Shepard, and this is my brother, Chris Shepard. We've been running Uptown Syndication for about 5 years now. Kind of a feather in our cap that came in the last couple months is we actually went full cycle.
6 years.
Well, 6 years. We went full cycle on the first deal that we put together.
6.5 years ago.
Achieved 20% IRR, and we're starting to get into the throes of selling some of the ones that we've put together. I think this is going to be the 13th or 14th deal that we've put together, and obviously we hope to continue to put these together in the future, and it helps with everyone's support. So our new addition to today is Ian. Ian, do you want to say a little bit about yourself?
Yeah, I'm Ian. I've known AJ for over 10 years now, and Chris for a handful of years. We connected through NARPM, which is kind of our association for property management. I own a similar business. We're a 1,500 unit management company up in the Seattle, Washington market. We have a construction arm and a real estate arm as well. And AJ and I was really interested in what they were doing, and so he brought me in, and we developed a coaching program, and I was one of their first to kind of go through it for a year. And after that, we started looking for deals. This one came across my plate, and here we are.
Yeah, and interest rates kind of rose and volume went down a significant amount. So this is the first deal that came across for us, and so we are partnering on this deal, which is super awesome. This is going to be our first partnership.
Yeah, our first co-GP. AJ and I have done all of our prior deals, as the solo sponsors. So this is exciting.
And so just to hit this off the beginning is this property is in Vancouver, Washington. This is our first time managing in Washington. And that's where Ian comes in. His company is based out of Washington and brings that experience to the table, which makes us feel a lot more comfortable about doing this whole entire deal.
We are licensed in Washington, and we'll be managing it under Uptown Properties. But Uptown has not made the jump across the river until now. So exciting times.
So this particular property is between I-5 and 205, and then just a little bit north of 14. It's about 13 minutes to the Vancouver waterfront, which is like a big, Ian and I, after the inspection, went and had lunch there, and it's a big $1 or $2 billion investment into the waterfront, and it's a great draw. And Vancouver's downtown has been improving. Ian, you went to a economic forecast and had got some information too, didn't you?
Yeah, Mountain Pacific Bank through kind of an industry event about 2 months ago, and one of the leading Zillow economists had come in to kind of speak, and it was interesting that Spokane and Vancouver were two of the markets called out as fastest growing. A lot of people moving to Spokane and then Vancouver, and a lot of people I think from Portland actually moving up into the Vancouver market. And then they had kind of made the joke, you want to live in Washington, shop in Oregon, and die in California. And so this deal checks two of those boxes at least for us. So yeah, so I typically Vancouver, just sort of drive by on my way to Portland, but the time I spent there now, I'm pretty excited after the research we've done on this market.
Yeah. And I forgot to mention, Sean has his camera on here because he is our asset manager. So he's going to be some of the boots on the ground doing the work out at this place, and just kind of wanted to give you guys a face with the name if it ever comes up. So thanks, Sean, for being with us too.
Absolutely. Nice to meet you all. And hey, I think this photo doesn't necessarily do it justice. It's beautiful up there. It's cool to walk the property and get to see it. And yeah, really cool piece of real estate.
Awesome.
Are we sharing our screen?
Yes.
Yeah.
Yep.
Okay.
Everybody can see our screen. So I'm going to go into kind of the overview of the project. It is
AJ, do you want me to talk about how it landed at all?
You're absolutely right. Ian,
Okay.
can you enlighten us on how this came across our desk?
I got to do my my value add to the webinar here. So I've been investing in real estate for about 20 years. Most of my stuff is off market. I love dealing with off market, going directly to the seller, kind of solving for their needs, and when it's kind of a win-win for the buyer and seller, it's just a really beautiful thing. And so a close friend of mine that I've known for about 20 years, his in-laws own this. They bought this about 10 years ago. They moved out of state. They moved down to Texas about a year ago, and ever since then, it's just become a burden for them. It was mismanaged through the management company down there. Um, they were kind of the landlords that like to go down there and make sure everything was going great. And so they're just very stressed. They got a refinance coming up. And so it's just these series of events. And so they reached out to me and said, "Hey, help us." So we drove down, we took a look. I called AJ. First thing we did was put management in place with AJ's company. So we're already ahead sort of on stabilizing this thing with the property management, which is kind of a unique thing, I believe, on these deals is we already sort of have operations set up pre-closing. And through that process, I just was super transparent on where we would be as an investment group. And we did some negotiating on it, and it was a win for them. They sort of got to de-stress on what was going to happen, get this deal done before the end of the year, early next year into January, and 1031 their money out. And so, yeah, so it was an off-market deal, came across through a personal relationship. And as you see, we're buying it right. And once you buy the deal right, everything else downstream, becomes a little bit easier. So, all right.
And we'll get more into the buying it right and why it's buying right later on in this. But that is absolutely the case. And yeah, so
Yeah, great job, Ian.
I think all of us are happy to be here. So going into the project overview, we got 29 units. It's across 5 different buildings, and they're all 2-bedroom, 1.5 bath. We look at a lot of apartment buildings. These are spacious in size. I would say 900 to 1,000 square feet.
That's a me.
So that is another thing that's a little bit nicer about this particular property than some of the other ones that we buy. We are looking to raise 1.4 million for this project, and we've already got some raised currently. So we expect that it's going to go pretty quickly. So if you do want to get in, I would reach out as soon as possible. So it's located on Kansas Street. The picture that we had up front, that is kind of like the front of the buildings. The backs have carports on them. There's parking for, I think there's more than enough parking for every place. It's on like a residential street, and what borders it is single family homes. And they're like 3-2 ranches, maybe 3-1 ranches, like very nice, good neighborhood. It's not in a very.
Speaking of the neighborhood, it's pretty close to one of our favorite golf courses in Vancouver, Royal Oaks Country Club, which our great uncle was a member at, and it's always a joy to get up there and play that.
Yeah. So we'll be investing $100,000 as the GP sponsor, at least in this deal, if not more. And yeah.
Well, we don't want to take up too much space.
So Chris, I'm gonna have you go through kind of the just general investor benefits.
Okay. Well, for people who have not invested in a kind of Class C value add syndication before, there are a ton of benefits. And the number one benefit is compared to, say, a development project, like we are going to start cash flowing on day one when we walk into the property. And this particular property, we are going to be cash flowing, I think about 7.3%, which is pretty rare in this market with the way the interest rates are. And, that says a lot about the incredible basis or purchase price that Ian negotiated. And there are some tax benefits for if you have other passive investments. And then just all in all, multifamily is pretty low risk. And then what this particular property type, with being a 2-bedroom and 1 bath, being the unit mix, is even lower risk because studios, expensive luxury studios, expensive luxury one bedrooms, those units are a little harder to lease as we enter into a downturn, and whereas a two bedroom, maybe somebody's renting out a spacious two bedroom. But then, when things get tough, they bring in a roommate. And so we find that, through the years we've invested, that it is a little more advantageous to rent out the two bedroom, one baths. Yeah. In regards to inflation, that, real estate investments do very, very well during inflationary times. And we are, a little bit above average on inflation. And so, yeah, I mean.
The intent is to do a cost segregation with this
Oh, yeah.
property, so we would expect, we always give a huge range here because bonus depreciation is coming back, so we'd probably be on the higher end of this range, but we usually, it's like a 20 to 50% loss in the first year. So those benefits can be used to offset other passive gains, or they can just be carried forward for future cash flow.
It has a lot to do with the loan size and the down payment amount. With this particular property, the building being 3.65 million, and our down payment, or the amount we're raising, is like 1.3. We're probably going to be pretty close to 100% of the invested funds for the cost segregation loss for that. But also the amount of cash flow we bring in too affects that as well. So if the property does extremely well and we give you if the investors make a bunch of cash, then the loss is, going to be less. So
that's a good thing. So we do preferred return. Our plan is to do a 7% preferred return. So we pay 100% of the profits to investors, and that goes to them first. After the preferred return, we have another hurdle. So from 7% to the 15% hurdle, the co-GP will take 20%, and then 80% goes to the investors. And then after the 15% hurdle, it's a 50-50 split on the profits. The preferred return we pay out quarterly, that's if cash flow allows for. This particular project of what we're looking at, the pro forma, we should be able to play most, if not all, of the preferred returns. With capital expenditures, if more people move out and we have to do a little bit more renovations, we may dip into that, but that shouldn't be until like year 1, 2, and 3. But we anticipate being able to catch up. The preferred return accrues if we don't pay it. So if we don't pay it in 1 quarter, it accrues and will be paid back before the GP takes any funds or profits. Ian, I'm going to have you go through the project timeline.
Yeah, great. So we got under contract sometime in the last 30 days or so. We actually just cleared our feasibility and inspection as of late last week on Friday. From there, we put together a pro forma and did the underwriting. We'll look to close this likely in early to mid-January. As I mentioned, we're already, AJ and Chris's company is already managing this. So by the time we close, we'd be looking at probably 3-4 months of management already stabilizing this, even though we were able to get it under contract 3-4 months in the past. So it's kind of a unique runway we've been able to build in here. This one is a pretty clear operational turnaround. And so we budgeted for 8 to 10 cosmetic remodels and bringing rents up to market, and some cosmetic work outside with the back patios, exterior paint. So we'll get that accomplished between January and August. From there, look to stabilize. And yeah, I think we ran a 5-year pro forma on this, but honestly, we could be in and out of it in 2-3 years.
Especially depending on how interest rates do. We're modeling a 6.5 cap for a sale, which is probably higher than what market is right now. And should interest rates go down a little bit, that could significantly improve, which is pretty cool, but we do not count on that. We try to do all of our underwriting as conservative as possible.
Well, we are acquiring this, I think, at a 7.3% acquisition cap rate.
Yeah.
You know, so we, in my underwriting, I threw on the 6.5% cap because most deals are trading around 6.25 right now. And then as far as timing with the sale, that is purely market dependent. You know, we're really waiting for external factors right now. Like with the 11 deals that we still have, you know, we're really waiting for the market to kind of turn for us, and we kind of think we're at the bottom, or we're coming out of the bottom. So I think we've got a year or two at least of that. So this project could be perfectly timed to catch a nice run up.
We do have a section in here on refinance. We don't anticipate doing a refinance, but we put it in there just in case. With this specific project, we're like everyone's saying, we're looking to stabilize, increase rents a little bit, and reposition the asset and probably sell in a shorter time frame. We do model everything on a 5-year just so investors can compare apples to apples. So we model everything on what like a 5-year would be. So yeah. Chris, do you want to go over the financial kind of pro forma on the next page?
Absolutely. I'll do a quick rundown on internal rate of return just so that everybody kind of understands what it is. Internal rate of return is essentially the continuously compounding rate of return that we use to measure the success of the project. Another, I guess, rate of return we use is annual average rate of return, and that is just kind of the average rate of return. It's a little bit higher. And so if there's any questions about, you know, time value of money, net present value, I'm happy to answer those in the Q&A.
And one of the reasons we use this calculation or function is that it more easily compares to the stock market. When you look at the stock market and say, oh, I can get a 7 or 8% return, that's 7 or 8% per year. So there's like time value of that. So this internal rate of return gives a better comparison to how the stock market would perform. We know that investors have a lot of options on where they want to put their money, so we try to make it as easy as possible to compare.
So in terms of the financials, we're raising 1.4, just to make it a round number, 1.4 million for this project. And year one, we're projected to get 7.3% cash on cash return, which is absolutely phenomenal. And then I projected that we would gently raise rents and that we would have a little bit higher, I guess, vacancy or bad debt in year one. And so cash flow is going to improve a lot. Going from years 2, 3, 4, and 5. All in all, if you looking at the member-based returns, we're looking at about close to doubling, a little bit more than doubling, $100,000 to $204,000 over the 5 years. And the exit, we're projecting a 5.8 million exit value price. And I know you guys are thinking, okay, we're getting this at 3.65. We're essentially saying that we're going to be able to increase the property value by 80%. That is a perfectly valid question. In this particular case, we are getting this property under market value. I would say, you know, the price per door is probably closer to $150,000 in this market. And so we are very fortunate to get these at about 125. So there's built-in equity on day one. And then as well, with the property management value add that Ian, AJ, and I are able to implement to a property like this, we actually do think that we can achieve these returns and probably exceed the return. On the deal that AJ and I did for our first deal, we acquired that at 1.1 million, and then we just sold it 6 years later for 2 million. And that was after we hit the peak and, you know, probably lost about 20%. We could have sold that for 2.3 million 2 years ago, when the market was at its peak. So,
the other kind of piece of information that very much supports what Chris just said is we sent it out to a couple lenders, and we have gotten quotes back at 80% LTV from most lenders. If you're purchasing properties in this market these day and age, most of the other stuff is around 65%, 60 to 70% LTV. So what that tells us is that the financials of this project and the price that we're purchasing at supports a higher LTV because of the cash flow, which then tells us that there is a significant amount of equity that even the lenders are saying that's in here.
all right.
Okay,
Are we on to Q&A?
I think so.
Ian, anything else?
No, I'm excited. AJ and Chris have been doing this for a while and have a proven track record. That's why we kind of brought them in. It's in their backyard, and I'm looking forward to it.
I guess maybe I will mention on the financing piece, we have not selected a lender yet, but all indications point to doing a Freddie Mac or Fannie Mae small balance loan. We just did a refinance with Walker Dunlop, so kind of right now they are our front runner. And we've got several quotes in front of us, or several options, but the intent is to go with the 80% option, and we're very confident that they can achieve that. We've worked with them on seven or eight of the deals, so it's been a good deal.
Yep.
All right, who's got some questions for us?
Curtis.
I do have one. Can you hear me?
Yeah.
Yes, sir.
Hey, AJ, good to see you in. I know both of you guys very well. What is the liability for the lending for investors?
It's non-recourse.
We're the sponsors are the key partners. So limited partners, we make sure that they are under 25% of the LP, so they do not sign on loans. Their names don't really come up other than in the LLC. So there's no recourse for any limited partners.
So as far as you know, no guarantees, and it's fine if there's like a credit check or something, right?
Nothing.
There's no credit check.
It's only on Chris, myself, and Ian.
Yeah, so we sponsor the deal, and all you have to do is sign the PPM and the subscription agreement, and it's very hands-off.
Thank you. And then what do you see the difference between the Vancouver market versus the Portland market?
That's a really good question. They are very similar. I mean, Vancouver is considered part of the Portland MSA. So the significant difference is the laws. And Ian is well versed in Washington laws, and they also are very similar to Portland. So we're very confident in our ability to manage the property. As Ian has said already, we've been managing it for a couple months now, and things are going well.
Yeah, I think Jim Henderson probably left. He's actually our Washington state lobbyist here for landlords, and I work with him pretty closely. This is another reason I like this deal is Oregon is actually tougher than Washington on landlord tenant law, which is surprising. So for those of you that are sort of on this call that are clients of mine or in my network, we're kind of getting the benefit of Washington, but the proximity and within the market of Portland. And so we'll be able to introduce things like tenant facing fees and some other things that are no-goes in Portland. So yeah, it's pretty interesting.
There's one major benefit is the tax situation for residents. there are very high taxes in Oregon and there is no income tax in Washington.
Yeah, no income tax.
And Vancouver's the perfect spot. I think, Ian, you mentioned this in the economic update, is like you could live in Vancouver, shop in Oregon, and get the benefit of not paying the sales tax when you're shopping in Oregon and no income tax when you're in Washington. I was reading through some of the kind of like market, I think the average age in Vancouver was 38. So you have a strong, like, young professionals and kind of working class. Portland itself is like 65% renters, whereas Vancouver's 50%. So you find that you get some migration from Portland into Vancouver, kind of pushing that renter pool up, also creating some demand.
Yeah, we
Vancouver- Oh, go ahead, Ian.
I was just gonna say, when we toured all the units, it was great. These are all actually townhouse style too. So all 2 bedroom, 1.5 bath, about 1,000 square foot townhouse style with ample parking, and a lot of working class, lot of small families, young families, or kind of still school age roommates. So it was a really good mix when Sean and I and AJ were out there sort of touring all these.
Vancouver rents have been historically lower than Portland, but I guess, as COVID has happened, there's kind of been a migration out of downtown Portland. The waterfront is being developed in Vancouver. I like the story that is being told in Vancouver, and I think the rents at the apartments, at this particular apartment, kind of represent that, and all of the comps that I've looked up support the plan that we have kind of put together, which is to take existing rents of around $14.50 for these roughly 1,000 square foot units to $16.75 over the course of 5 years, and so and as well implement RUBS, and so that is roughly a $325 premium that we're hoping to implement over the 5 years. So yeah, great question.
Very achievable.
Hey guys, it's Ray.
Hey, Ray.
Hey, Ray.
Hooray!
Chris, I like the dad beard that you got going
Oh
on.
yeah,
For sure.
I'm not shaving until she starts sleeping.
I don't blame you. I don't blame you. Hey,
No.
for those for those that are new on this would be my third venture with these gentlemen, and proven track record. If you guys have any doubting at all,
We're not paying, Ray. We're not paying.
yeah, no, they're not, and I'm probably the cheapest guy on this thing. So if I didn't think I could do right, if they wouldn't do well by me, I wouldn't be with them. But so far so good. If anybody needed an opinion away from the great presentation that they make, either reach out to me or my statement should be enough. So good luck, guys.
If anybody else wants any other recommendations, we've got plenty of other investors that we're happy to put people in contact with.
I appreciate that, Ray. This is Rob. I'm out of California, actually. I was stationed in Washington. That's where I got the house or the townhouse that Ian and his team are managing. Just a couple questions. One, I think Vancouver is better than Portland. Just from what I've been reading, Portland safety and crime has gone a little bit up from what I've read. But so, and I think you might have answered one of my questions with Washington state tax. So I don't need to, if I live in California, I don't need to worry about that, or should I just give that to my tax person and let them handle it?
We develop K1s. We shoot to have them at the end of February to investors for tax purposes. So however many people invest, we put together a K1 that shows their your losses and your gains and everything else. So you just
Okay.
hand the K1 to your tax guy and he plugs it in.
And we file the partnership return, so you don't like as if I'm not a CPA, but I'm quite sure that, well, I believe that you don't have to file a personal return for Washington State if you are out of state. You just get the K1. We are filing the return and doing that tax return for you.
Okay, appreciate that. If, if, do I understand, and I may have missed it, and I apologize, there aren't any upgrades that are planned for the apartments. Is that fair to say? No.
So we're raising 1.4 million and about 370K of that is for cosmetic remodels on the units. Ian and I walked, I would say 80% of them
And
are,
Sean too.
and Sean too. 80% of them are kind of classic. There's a few that have been updated, but not too many. And so the opportunity is, as we raise rents and some people decide that it's not for them, we are able to renovate those units and achieve a much higher rent, just because of the quality of the.
Sure.
we're able
No,
to do.
no, I mean,
There is a tiny bit
I'm all
of
for
deferred
that.
there's a tiny bit of deferred maintenance with the carports and then the back fences that we're going to address as well.
Okay, no, I appreciate that. And I think that's important to, I think the objective of this is to provide good housing for people. So
Yeah.
yeah, I'm all for that. Yeah.
Absolutely.
Well, and as the GP, we want to be well capitalized too. Like we pride ourselves in not coming back to investors and asking for more money.
Sure.
We have a nice budget, like I said, 370K in there. And that's out of the 1.4 million that we raise.
Okay. And I don't want to hog the whole thing, but
No, you're fine.
my final one is I think from what I've read that you prefer 100K, but is 50K acceptable? And
Yeah, we do a 50K minimum. Yeah.
okay. And when is your kind of a deadline for decision? I know you said in the beginning,
we anticipate
think fast,
it's gonna
right?
fill up quick. I mean, I think that we've already got almost 400K in commitments. So you can actually log on to your portal and put in a soft commit. We're gonna do first come, first serve. So there's 30 or so people on here, and I would imagine it will fill up pretty quick. You
Okay.
can also text Ian, Chris, or myself, or send us an email and say, I'm in for 50. The process kind of after that, we'll take soft commits and we start filling out subscription agreements. We send you a subscription agreement to the LLC, which is signing like, yes, I'm committing to that much money. And that will kind of solidify that. We call that more of like a firm commitment.
And that's through like an electronic exchange.
Rob, I
type of-
can,
Yeah.
I'm happy to coordinate some time with you tomorrow morning too, to kind of walk you through the steps. I know some of my
Well,
invite.
Ian,
Okay.
it's good
Thank you.
information for everyone too. So
Yeah.
we'll send the subscription agreement over DocuSign. There might be some stuff you need to fill out as like, well, who you are, how you know us, kind of just what sort of entity you're investing in.
Yeah.
So we,
AJ, I haven't set anybody up on the portal yet. I think it's a confusion. So anybody that I invited here,
yeah.
I'm going to be reaching out, and just to make sure, since this is the first time, if all your questions are answered, you're super comfortable, transparent. We're going to be sending out all of the additional documentation needed, and then from there you'll be invited to kind of a portal that has everything. From there you'll be able to go do everything AJ and Chris kind of just talked about to sign up for your commitments and lock it in.
Yeah. Or
Okay.
if
Appreciate it.
you really want in, just email any of us and we can quickly put you in line in queue. And like I said, first come, first serve.
Okay,
Okay,
gotcha. I gotcha. Thank you.
Steve,
Lawton has a question.
hold on, let me catch up a little bit here in the
Okay.
chat. Steve, the first K1 we're gonna acquire it in 2026, so 2026 would be the first tax year.
And that would come in February of 27.
Yeah.
Yeah. Reggie has a question. You do refi, how is that handled? And question one, and what are their, let's see here.
What are the fees? So asset management fees are 3%. Disposition fee is 2% of the gross.
As far as a refi, we don't anticipate doing a refi on this property. We believe it's going to be a shorter term than the normal 5 years, but again, we model everything on 5 years so investors can compare apples to apples.
But if interest rates drop 2%, we would probably refinance. I think we're looking at a 3-2-1 step down prepayment penalty with the loan. And I guess for refinance, how it's handled is that we just take care of it. So we'll, like, part of this syndication model is that as a limited partner, you're putting your trust in the three of us to make the best decision for the property and to produce the highest net income and the highest sale value, and also just provide the best returns that we possibly can. And that's our goal. We're not looking to maximize fees. We want to, being limited partners ourselves, we are looking to produce a return for our investors.
All right, before Lawton, hold on one more minute here. And speaking of the returns, I was texted a question. Ty had asked what the management fee is, and because we did such a good negotiating on price, we negotiated a very good management fee of I can't remember, at 5 or 6% with Uptown. And so again, you guys are welcome. Steve, problems with the previous management company. These owners were very hands-on. They love to drive the property, and it's very well maintained, even though it's an older asset. The landscaping was well maintained. And the problem they were running into is there's just some deferred stuff. And it's only in like the last 6 or 9 months. When we were there, a lot of the tenants were saying, hey, I put this maintenance request in. I haven't heard anything from the management company. So it's just some small operational stuff that can be turned around very quickly. There wasn't vacancy. There was 1 unit vacant when we were sort of going through negotiating on it. That's been rented. And then there was 1 vacancy when we were sort of inspecting it, which AJ's team probably rented. So it's either fully occupied or there's 1 vacancy on market right now. So it was really, I think the owners were just kind of stressed out because they were out of market and they couldn't just go drive over there and fix things anymore. And they're a little older. They didn't want to have to deal with the refinance next year. And they actually 1031'd out of commercial real estate and into a Delaware trust, I think. So they're just sort of winding down, and that's how we acquired it. All right, Lawton.
Hi.
Howdy.
Hello.
I know it was kind of covered, but and it sounds like you said you kind of pride yourself on this, but what does happen if there is a cash call? Have you run into that with any of the 14 deals where the numbers are, something comes up and you're like, we need more money?
All of our deals have cash flowed, so we haven't run into a capital call. There has been a couple additional capital expenditures, but small in nature. We offer the investors the opportunity to loan money to the business if they want that. Otherwise, we loan money to the business ourselves. And those, like, we did it on 1 deal for like $20,000. And that was it.
Okay.
So the property is projected to produce $100K of cash flow per year. And so, that's significant funds that we, like, if we do run into an unexpected capital expenditure, we can phase out paying that and essentially, but yeah, in all of the deals that we've done so far, knock on wood, we haven't had to do one yet. And yeah, I feel like we've got a little bit of experience under our belt. AJ and I have been investing since 2006, and we bought a property at least one property every year, since 2006. And we,
Done some 1031s and haven't sold many.
right? But yeah, all in all, like we hope to not do that. And I feel like we have underwritten the project pretty conservatively, so that we won't have to do any type of call.
Cool. Yeah, perfect. Thank you so much.
Cheers. David. David, do you have a question? Okay.
Yeah, any other questions before we wrap up and go get a cocktail?
I've got to go change some diapers.
Chris is gonna get a bottle. Yeah, exactly. Yeah.
Well, again, I mean, we just want to say thanks everyone for showing up and showing us support. You know, we wouldn't be able to do this without all the great support from investors. And, you know, this is first deal we're doing with Ian and our first partnership. We're super excited for it. We think there's a lot of good synergy, and, you know, from this one, hopefully we'll see some more. Awesome.
All right.
All right.
Thanks,
Thank you, guys.
Everybody take care. We'll send out some stuff.
All right. Thanks,
Thank
guys.
you.
Bye.
Thank you.